All right, hey, welcome back to Principles of Counting One. It's already January 20th, if you could believe it or not. The time goes by so quick. We already had our first full week of classes here at UDC this past week, and your task for last week was to complete the Chapter One quiz. Um, Now, if you're new to the class, which is totally fine, there's a couple of things I want to call your attention to. The first thing I want to call your attention to is the start here area, and then coming down to the syllabus. This syllabus is your guide, if you will, your roadmap for the next 16 weeks or 15 weeks. And as you come to the syllabus, you'll see my contact information here at the top. This is technically an in-person class, although your registrations does say both in-person and remote instruction, which is why we're doing some sessions on Zoom and some sessions in person. Um, we will be meeting every Tuesday from 5:30 to 6:50. The time that you have for Thursday will be for you to be able to complete your work in the classroom. I'll be available, of course, during that time, but we won't be having a lecture on Thursdays. That Thursday time is used for you to be able to complete the work for that respective week. Coming down the syllabus, I wanted to call your attention to probably the most important area, just once again, and that is the course outline, the course schedule. And last week was January 12th to 18. We met on Zoom on the 13th, which was last Tuesday, and we covered chapter one. You'll notice that every single week we have Excel exercises, a Firebird Cookie Company exercise, and a quiz. The only thing that's graded is that quiz. The Excel exercises and Firebird Cookie Company exercises, those are not graded. They are there for your hands-on learning experience. I do want you to please definitely do the at minimum the Firebird Cookie Company exercise because it's really beneficial for you to get that hands-on learning experience, and it helps a great deal, especially when it comes to taking the quiz and also remembering the content. Uh, so here we are in week two. This week we're going to be talking about recording transactions in chapter two. And also this week we have the same Excel exercises, Fiber Cooking Company exercise, and the chapter two quiz. The chapter two quiz is graded, the exercises are not. Next week we're going to meet in person in room 301 on campus. Um, and that's on the 27th. We'll meet in person on campus room 301. And then while we're there, we're going to cover chapter three. Uh, and then so forth and so on. And it goes on like that. And that's every other class time would be Zoom, and then the next would be the room, and then Zoom, and then back to the classroom, so forth and so on, right? So, but don't worry, I'll continue to send out reminders and through the messages and all that. Questions, comments, concerns?
I have a question.
Dario, please.
So, for the people who missed the first week, are we still allowed to take the first quiz or no?
Yes, please. I would definitely need you to please. For those of you who did miss that first week and you were just enrolled in this course, please definitely go back to week one in the classroom content area, which is right here. So you click on week one. Um, Definitely read through the information, do the practice exercises, and then definitely take that chapter one quiz as soon as you can if you are newly enrolled to the class. Great question. Star, please.
My question would, so I was listening. Do we like only have classes on Tuesdays and like Thursdays are basically in asynchronous?
Correct. That's exactly right. So we're only going to have our in-person lectures on Tuesday, either on Zoom or in the classroom, whichever one the syllabus says. And then on Thursdays, that class time is reserved for you to be able to complete your quiz for that week or your work for that week.
Okay.
Excellent. Great question. Very good. Any other questions before we jump into chapter two?
Yes, Professor. For
Data.
the Firebirds cookie, um,
Yes.
I don't think you're able to like even complete it because on my end, I even if I try to complete it and put my name in and everything, there's like no way for you to like submit it or check for correct answers. And once
Really?
you,
Hmm.
yeah,
Okay.
Yeah,
Uh,
that happened to me when I did it too.
did it? Okay. Oh, that's good to know. So that could be a technical issue. Is my question to y'all that had that issue is did you what browser are you using?
So, hold on, Professor. I
Yep.
stepped away for a minute. Is we talking about the message that I sent you about the exercises?
Yes.
Oh, okay, yeah. I'm in agreement with them. You couldn't submit it or check to see if you had the right
Okay.
answers.
Sounds like a technical issue. So what I'll do
I
is,
was
I'm sorry, please. Start.
oh, you had asked what
What browser? Yeah.
yeah,
I used Safari, but then I also used Google and Chrome, and it was like doing the same thing.
yeah, same as me. That's why I sent that message saying I would just email it.
Ah, okay. Got it. Okay, no worries. So what I'll do is I'll take a look at the source code. So I hand coded a lot of these using HTML. And so what I'll do is I'll go back in and double check that source code. That could probably be the issue, is maybe I made an error in the code. Um, and I'll double check that to see if that's what the issue is. But thank you so much, everyone, for bringing that to my attention. I'll definitely take a look to see what the problem is. So thank you, appreciate it. Anything else before we get started with the cut? Good.
So, Professor,
Yeah,
the none of the exercises are exercises just for practice. Only thing that's due is the quizzes, right?
that's correct. Yeah,
Okay, perfect. Okay.
yeah, excellent, great, awesome. Thank you all so much for your questions. So what I'd like to do now is go ahead and let's get started with our week two content, which is transactions. This is a really fun topic, especially for those of you that maybe own your own business or are thinking about getting into business. This is a really interesting topic for sure. So what I'd like you to do is in the classroom, definitely go through the content. Under instructional materials is where you'll be able to find the PowerPoint presentations. So if you go to instruction materials and click on instruction materials, you can follow along with us. The chapter two PowerPoint is there. So each week the PowerPoint is located within instructional materials. And Star, you have your own business as well. That's awesome. What kind of business do you have?
Um, I make and sell cupcakes. My business is
You're
actually
kidding.
called, yeah, it's called Frosted AF.
That's
AF stands
awesome.
for, it's an allergenic free business. So I make cupcakes that don't contain chocolate, strawberry, or nuts, because that's what I'm allergic to. And
Sure.
I try to make cupcakes for people who are allergic to the same thing so they don't feel excluded from other desserts.
That's awesome. I love that. Very, very cool. Very well done. That's fantastic. I love hearing that. And that's a great story for the business and something to be proud of. That's great. I look forward to talking with you more throughout the semester about that. So very cool. Okay, so let's go ahead and jump into these transactions, and I'm going to walk you through a lot of basic conceptual framework behind transactions, why we record them, what the transaction does to the accounting equation. And I'm going to talk a lot more technical components about transactions, but I really want you to understand what the impact of each transaction is on the business. And I'll give you a couple of examples from my business, my experience, and maybe some of your experience as well on these transactions and how they're recorded and why we record them and what the impact is on the business. So the first thing we really need to understand is our financial statements that we briefly talked about last week and how the transactions impact those financial statements. So when we talk about financial statements, we're primarily talking about the income statement, which shows all of the company's sales and expenses. The balance sheet, which shows the balances of all the company's asset accounts, liability accounts, and equity accounts. The statement of owner's equity, which shows owner contributions, net income, owner's withdrawals to get our retained earnings. And the fourth financial statement is the statement of cash flows, which represents cash coming into and out of the business for operating activities, investing activities, and financing activities. So those four primary financial statements are generated or created based off of the transactions that occur in the business. So we look at a transaction as being an event, a business event, if you will, and we need to be able to identify every single transaction that has occurred in business, in our business, in the business. So ways that we do that is by looking at what we call source documents. These would include things like bills that we receive from our suppliers, or checks that we receive from our customers, or purchase orders, payroll records, that type of stuff. We call those source documents. It shows us that transactions have occurred. We analyze those transactions that have occurred. We look at what the impact is on the accounting equation. Assets equals liabilities plus equity is the accounting equation. We look at the impact each transaction has on the accounting equation. We record that transaction in our QuickBooks or Sage or Oracle or whatever accounting system you're using. We record that transaction. We have one account that we debit, one account that we credit for each transaction. We post that transaction to our general ledger accounts, which are the two accounts affected by each transaction. And then we analyze the trial balance to make sure our debits equal our credits. And then we look at preparing our financial statements, income statement, balance sheet, statement of cash flows, and statement of retained earnings. So that's the process that we follow with every single transaction. It sounds like a lot, but it actually happens pretty quickly, especially these days with accounting software. Source documents are the documents that we use to identify that a transaction has occurred. Examples of source documents include the bills we received from our suppliers, sales receipts from our customers, checks that we've either paid out or received from customers, purchase orders that we sent to our vendors, payroll records that we use to identify how much we paid our employees with, and of course, bank statements. The bank statement shows all the cash coming into and out of the business. So we use these documents to then make our journal entries, to make our transactions, right? We put those transactions into our accounting information system. So you hear me use the word account a lot. An account is a record that's an asset, a liability, or an equity account, or it could be a revenue or an expense account. The individual record is what we call an account, and that account or record shows all of the different transactions that have affected that account. Okay, I'm going to show you what all this looks like here shortly. These accounts collectively are posted to what we call the general ledger, which is a record of all of the accounts and their respective balances. Okay. So I want you to think of like a computer database, how that works. Think of the individual files as the accounts. Think of the hard drive as the general ledger. There's a separate account that make up your assets, liabilities, and equity. Assets are what the business owns. These are resources that the business owns. And these assets are used to help the business to generate sales. If you think about it for a second, I need cash in order to operate the business. I operate the business to generate sales. Accounts receivable. Accounts receivable is when I made a sale to a customer, they haven't paid me yet. So earlier, Chef Kevin and I were talking about customers that haven't paid yet. So those customers, hopefully, Kevin, have what we call an accounts receivable, and that they'll pay, Kevin, 30 days later or less, hopefully less. That's the nature of business, right? So we have cash, accounts receivable. That's when we've made the sale or delivered the good or the service to the customer, and they have not yet paid us. That's account receivable. We expect to collect the account receivable later. It's an asset because we have a claim to that amount. Okay? We have what we call notes receivable. We sometimes convert a customer's account to a note and we attach interest in the event that they don't pay us. This is designed to encourage them to pay us. We have inventory. These are the goods that we have available for sale, right? Inventory. Just like a retailer has inventory. Macy's, one of my favorite companies, they have inventory. They sell clothing and home goods and that type of stuff. That's their inventory. We have what we call prepaid accounts. A prepaid account is quite simply we paid in advance of incurring that expense. A classic example of a prepaid account is prepaid insurance. I pay my insurance for a full year starting on February 1st. Okay? It's called a prepayment because I'm paying it in advance of the expense happening. It becomes an expense after I have used or consumed that expense. I'm going to show you what that looks like later. We have supplies. In Star's business, and probably also in Kevin's, we have things like parchment paper or foil or aluminum pans, that type of stuff, right? We call that supplies. It's an asset to the business because we use them in our process to create the product that we later sell to the customer. We also have, probably in Star and Kevin's businesses, equipment, like an oven, for example. That's a piece of equipment that we use to create our product. We have buildings, that maybe you own the building. Okay, that's an asset because we use the building to help us to generate sales. And of course, land that the building sits on is also an asset. Okay, those are all your asset accounts. Then we have liabilities. Liabilities is anything the business owes to someone else. Okay, the liability is a claim against the business. We owe money to somebody else, therefore it's a liability for us. Okay, an example of liabilities include accounts payable. Those are bills that we've received and have not yet paid. Accounts payable. We can also include wages payable. My employee worked for 2 weeks. I haven't paid them yet. That's called wages payable. It's a liability because I owe them the money. Taxes payable. I collected sales tax from my customers. I have not yet paid the sales tax to the tax agency. Therefore, it is a liability for the business. We have notes payable. These are loans that the company took out, and we have to repay them. Accrued liabilities. Those are your wages and taxes and all those other things. Yeah, we call those accrued liabilities. And then we also have this thing called unearned revenue. Sometimes a customer might pay you before you deliver the good or the service. That's called unearned revenue. The reason why that's a liability is because, God forbid, we don't provide the good or the service, we have to pay the customer back. Okay, therefore it's a liability for us. Okay, those are all your liability accounts. And then we have what we call equity accounts. This is what the owners of the business owns. This is what the owners of the business owns. We call that equity. Okay. Equity accounts include owner's capital. These are contributions that the owner made to the business in order to get it started, in order to keep it funded properly. Any contributions that the owner makes to the business, we call that owner's capital. I'm going to give you an example. Let's say Star, with the business that you have, maybe you own the oven that you use, and you provided that oven to the business. That would be the value of that oven would be a part of what we call owner's capital. Or if you invested cash to get the business up and running, that would also be a part of what we call owner's capital. Anytime the owner wants to take money out of the business, we call that owner's withdrawals. Owner's withdrawals, anytime the owner takes money out of the business. And then we have our revenue, which is our sales, and our expenses. These are your day-to-day operating expenses like rent, utilities, etc. So revenue minus expenses equals net income. Revenue minus expenses equals net income. That is all a part of equity. So assets equals liabilities plus equity is the accounting equation. It's important to remember the names of these accounts. So quickly again, for assets, these are anything the business owns. Okay, cash, accounts receivable, those are what we made the sale to the customer, delivered the good or the service. Customer hasn't paid us yet. That's an account receivable. That'll go up when we make this sale. Customer hasn't paid us yet. It'll go down when the customer pays us. Notes receivable. We took out we converted a customer's account to a loan. Prepaid accounts. Most common one is prepaid insurance. We pay our insurance in advance, maybe a year in advance. It could also include things like prepaid rent or other prepaid services. Supplies, these are things that we use in order to generate sales. For examples of that, especially in a catering business or in a baking business, we have things like parchment paper, foil, aluminum trays, etc. Those are all supplies. We have equipment. These help us to generate sales, obviously, because we use the equipment to create whatever it is that we're creating. These lose their value over time through this process called what we call depreciation. We'll talk about that in a later chapter. The building also depreciates in value over time. This building could include things like a store, office, warehouse, factory, etc. And then the land. The land itself, we never depreciate land. The land sits on top of the building. We report land and buildings separately because they're not the same thing, obviously. But those are all your asset accounts, is what the business owns. Liability accounts is what the business owes to someone else. Accounts payable, these are bills that we have received, we have not yet paid. This would include things like we purchased inventory from our suppliers, haven't paid them back yet. That generates what we call an accounts payable. It goes up when we receive the bill. It goes down when we pay the bill. Notes payable. We took out a loan, haven't paid it back yet. Accrued liabilities. This is your wages payable, taxes payable, etc. Payable. And then we have unearned revenue. We receive payment from our customer before we deliver the good or the service. It's called unearned revenue because we have not yet provided the good or the service. If we don't provide the good or the service, they have a claim to that money back. Therefore, it's called unearned revenue and it's a liability. It becomes earned revenue when we deliver the good or the service. And our equity accounts. The owner makes contributions to the business. We call that owner's capital. The owner takes money out of the business. We call that owner's withdrawals. Cash coming into the business from the owner, minus any withdrawals the owner takes. And then we add in our net income. That becomes ending balance owner's equity. We have revenue, which is our sales, minus our daily operating expenses, things like rent, utilities, etc., repairs and maintenance, you name it. Revenue minus expense equals net income. These are all your equity accounts. Remember, it's what the owners of the business ultimately own. Okay. We can look at this through the expanded accounting equation. Assets equals liabilities plus equity. Within equity, we have owner's capital minus owner's withdrawals plus revenue minus expenses equals ending balance owner's equity. And as I had mentioned before, all of those accounts, all those individual accounts, they get posted to what we call the general ledger. The general ledger is contained and has a list of all the account balances. That list is called the chart of accounts. Chart of accounts is a list of all the accounts using a specific identifying number. And the balances are on the ledger. That's what accounts are. All right. Remember, if you have any questions, please feel free to unmute your mic and ask, or if you want to type it in the chat or whatever, questions are always welcome. All right. So now that we know what accounts are, I want to explain to you how debits and credits work. And ultimately, I'm going to, this will help you to better understand how the accounts are interfacing with the accounting equation and what happens when we either debit or credit the respective account. We oftentimes like to visualize things, to understand how the balance comes to be. So a way that we could do that is through what we call a T account. It's representative of the individual account. So the account title, we could call that cash. And in order for us to increase cash, we debit cash. To decrease cash, we credit it. Let's say it's a liability. Let's say it's account payable. To decrease the account payable, we debit it. To increase an account payable, we credit it. And let's say it's an expense account, which is equity. To increase an expense account, we debit. To decrease an expense account, we credit. It's important to know this because when we make our transactions, you need to know whether we're going to debit the account or credit the account. So we use what we call a double entry accounting system. This means that every single transaction involves at least two accounts, one of which will be debited and the other will be credited. Now, every transaction has an impact on the accounting equation. I like this chart a lot, or this slide a lot, because it shows us what the impact is if we debit or credit the respective account. To increase any type of asset account, we debit it. To decrease it, we credit. The opposite is true for liabilities. Think of it this way. When we move from one side of the equal sign to the other, we need to change the polarity. So, in order for us to decrease a liability, we debit it. To increase a liability, we credit it. And for equity accounts, it's a little bit different for equity accounts because, as you know, with equity accounts, we have owner's contributions, owner's withdrawals, revenue, and expenses. Now, because we have those four different elements within equity, I prefer this slide here to show us exactly whether we debit or credit to increase or decrease our equity accounts. For owners' investments, to decrease our investments, we debit. To increase, we credit. For owners' withdrawals, to increase withdrawals, we debit. To decrease, we credit. Remember, once we move to the opposite side of the polarity, that's when the polarity changes. For revenue, to decrease revenue, we debit. To increase revenue, we credit. And for expenses, to increase our expenses, we debit. And to decrease our expenses, we credit. I want you to pay very, very particular attention to this slide because this will certainly help you with every single transaction you ever make. Because, as you know, one account needs to be debited, the other needs to be credited for every single transaction. This slide will certainly help you to be able to remember whether you're debiting or crediting based off of the account name. And, of course, what's happening. So, earlier I had told you about those T accounts. The T accounts, as you can see here, hold a record of the individual account. Well, here we have the account name. This example is cash. On the left side of the T account, which is the debit column, to increase an asset, we debit it. And so you can see on the left side of this account, all of those three different transactions or collective transactions, we can see they're all increasing the cash balance. On the right side, we're decreasing our cash balance. And here we can see we've used cash for a couple of different purposes. We purchased some supplies, some new equipment. We paid for rent. We paid our employees. We paid our accounts payable, which are our bills. And the owner took out some cash. Right? So we take the cash that came in minus the cash that went out to get the balance. In this case, thank goodness, it's a positive balance of $4,800. But that's where those T accounts really come in handy because it shows you an exact record of what's going on within that account. Now that you have a really good understanding of the different types of accounts that we have, the accounting equation, the normal debit or credit balance of each account, I'd like to walk through several transactions with you to help you to be able to really understand what's going on and how those transactions are made and how they impact the financial statements. So, as I showed you earlier, there's really a four-step process to creating a transaction. The first is to figure out what happened, and we figure that out by looking at the source documents. The source documents tell us about the transactions that have occurred: bank statements, purchase orders, sales receipts, bills that were received, etc. You know, those are all your source documents. We look at those, we analyze those documents based off of the accounting equation. Okay, based off this bank statement, did cash go up or down? You know, what was, so those are obviously affecting our assets. The purchase orders are our liabilities and assets going up and down. What's going on with that? That type of stuff, right? So we take the source document, we analyze it based off of the accounting equation, assets equals liabilities plus equity. Then we record the transaction based off the source document and the impact on the accounting equation. And then those transactions get posted to our general ledger accounts. So that's the process, and that's the way that it works. Every single transaction that you come across is going to have a couple of key elements to it. One being the most important is the date. The reason why the date is so important is because we need to know what month the transaction belongs to. The second thing you'll notice is what accounts are being affected. There's, as you know, there's going to be a debit account and a credit account. And then, of course, the amount. We need to know what the amount is. It's important that every single transaction, your total debit amount equals your total credit amount. If they don't equal, that means there was an error that has occurred. And last part of a transaction to note is an explanation of that transaction. Why that transaction took place is very important. So that way, when we look back in time as a manager, you need to be able to understand what the transaction was for. If you ever get audited by the IRS, God forbid, then we can explain what happened. So that's how we journalize a transaction. We look at our accounts individually and every single transaction that impacts that account. So here we have an example of cash, our cash account, and we can see a list of transactions that have happened throughout the month of December and what the impact was to our cash. Remember, the cash goes up when we debit it, it goes down when we credit it. So December 1, probably an owner's contribution to the business, 30,000. December 2 looks like some type of expense that we paid out. Same with this December 3, I think we purchased some equipment. December 10, we received some revenue from our customers, so forth and so on. So this is just a nice snapshot of your cash account, you know, what's going on with the cash. Very, very important to always know where your cash is at all times, what your balance is at all times. So for each transaction, we go through those four steps. And what this does is what this is doing is it's showing you how those transactions get posted. So the first thing we did is we identify the transaction as occurred. We look at what the effect is on the accounting equation. Then we we record the transaction, and then of course we post that transaction to the general ledger accounts. We can see that in this particular transaction, the owner made an investment to the company, so the cash went up by the 30,000, and the owner's equity went up by 30,000. This diagram just kind of neatly shows you how it all gets posted. So we follow those same 4 steps for every single transaction, and it really does help us to make sure that every transaction we're creating is accurate. So we identify the source document, record the transaction using the accounting, analyze using the accounting transaction equation. We record the entry, and then we post the entry to the ledger accounts. So same 4 steps every single time. Now, what I'd like to do is I'm going to walk you through a bunch of transactions, and I'm going to try to go as slow as I can so that way you understand exactly what's going on in each transaction and how that transaction is going to ultimately affect our accounting equation and our financial statements. So the first transaction that we have here in our example is a contribution from the owner to the business. Now, here we have an example where the owner is starting the business. This is a brand new business. So the owner is investing $30,000 of their own cash into the business to get it up and running. Now, anytime the business is receiving cash, we're going to debit cash to increase our cash. And so we follow the 4 steps. The first step, we identify the transaction. What's going on here? Owner investment, okay? Step 2, what's the effect on the accounting equation? Well, my assets are going up because I'm increasing cash by $30,000, and there's an increase to the owner's equity, $30,000. The third step, record the transaction. So I'm going to debit cash, $30,000, cash going up, and I'm going to credit owner's capital, $30,000, to represent the increase in the owner's equity. And the fourth step is we post those to the general ledger accounts. Now, as you can see here, especially with the accounting equation, we have an increase on our assets and an increase in our equity. There's nothing going on with liabilities because there's no liability. As long as your total assets equals your total liabilities plus equity, it's okay, right? And the majority of transactions only have 2 accounts. So in this case, we have cash and we have owner's capital. Here we go with the second transaction. Now, in this transaction, the company is purchasing supplies, which is an asset, and we're using cash to pay for it. All right. So, just as I'd mentioned before, with the example of our chef and of Star's businesses, Chef Kevin and Star, with their businesses, they need to use things like parchment paper, foil, aluminum pans, etc., to be able to help them to create their quote unquote product, which is the service or the food. And so given that, supplies is an asset, right? Because it helps them to generate sales. So, purchasing $2,500 in supplies, we're paying cash. So what that means is that our supplies account goes up. So we're going to debit supplies, and we're going to credit cash. Or cash is going down. Now remember, to increase an asset account, we debit it. To decrease an asset account, we credit it. So in this case, both of these are asset accounts. Our supplies goes up by $2,500, and our cash goes down by $2,500. So you can see the impact on the accounting equation. Supplies went up, cash went down. It nets out. What I mean by that is we're still in balance here. We're just changing, we're increasing one debit account or decreasing one debit account, both by the same amount. So there's really no change to the accounting equation. Supplies by 2,500. We credit cash by 2,500. Supplies going up, cash going down. Then we post the transaction to the general ledger accounts. We see supplies went up and cash went down. Any questions so far? Kevin?
Professor.
Yeah.
What does PR mean? When you got PR 126 and 101. Did I miss that?
Oh yeah. No, you're good. So PR is the account number.
Oh, okay.
Yep. So those are just the account numbers. So the general ledger is contained within what we call the chart of accounts. And the chart of accounts, every single account has a unique identifying number associated with that account name. And what that does is it helps us to organize the accounts within the business in a logical way. And it's usually done in the order of liquidity, which is why we see cash being 101 or 100 and supplies being 126. So great question. I hope that helps answer it.
Yeah.
Awesome.
But the PR don't have a name to it. It's just the account numbers.
It's
So
just
PR
account numbers.
don't.
Yeah,
Okay.
yeah,
All right.
yeah. You can ignore that PR part.
Okay.
Yeah. To directly answer the PR question, so PR basically is a way for the accounting information system like QuickBooks to
Mhm.
to categorize the account number.
Oh, okay.
That's all it really is. Yeah, great question. Awesome. Great. So let's take a look at the next transaction. And in this transaction, it looks like we're purchasing a piece of equipment to help to increase the capacity of the business. Now, obviously, I need equipment to help me to generate or to create my product. Yep. So here we have an example where we're purchasing a piece of equipment for $26,000 in cash. So I look at the transaction, I look at the impact on the accounting equation. Now, just as before, equipment is used to help the business to generate sales, which means that it is an asset account. So I'm going to increase my equipment account by 26,000, and I'm going to decrease cash because I'm paying for it in cash by 26,000. Once again, the accounting equation is in balance. It nets out. Equipment went up, cash went down. They're both asset accounts. And as long as they go up and down by the same amount, there's no effect on the accounting equation. So the third step, we record the transaction. We debit equipment, credit cash, 26,000. Then we post the transaction to our general ledger accounts. We see equipment went up, and we see that our cash went down by those respective amounts. Now, if you were to look at the cash balance here, on the right side, which I wish that this slide showed us that, but it doesn't. But we can easily calculate the balance of our cash at this particular point in time. We started with 30,000. We paid 2,500 for supplies. We paid 26,000 for cash. I'm sorry, for equipment. So what's our balance?
1,500.
1,500? Looks right to me. Yeah, of course. Yeah, it's $1,500. That's what we got left. So let's keep going. Now, knowing that I only have $1,500 in cash, I got to be a little careful now because my balance is getting a little low. So what do? I need supplies. Oh my goodness. How can I purchase $7,100 supplies? I don't have enough cash. Well, this is where my business people come into play. And they say, hey, supplier. They reach out to their supplier, their vendor, and they say, hey, vendor, I'm going to make a deal with you. Okay. Vendor says, all right. What kind of deal we talking? They say, hey, listen, I'll sell you the $7,100 in supplies, and you're going to pay me 30 days later. We call that purchasing on account, right? It's like setting up a line of credit with the vendor, right? So if you don't have enough cash on hand, contact your vendor and say, hey, listen, I'd like to establish an account with you where we work on what we call credit terms. The credit terms are, I'm going to pay you 30 days later. And if they agree, that's great, right? It helps you out because you don't have to worry about coming up with all that cash so quickly, right? And I'm sure my business people in the classroom know, you know what it's like. It's hard to have that much cash on hand all the time. You need it for your other operating expenses. So when you don't have enough cash on hand, or you want to be able to control the cash that you have on hand, establish a relationship with your vendors, establish credit terms with them, make an arrangement where you pay them 30 days later. Okay, so that way you can conserve your cash. That's what this example shows us. So we obviously only have $1,500 in cash. I need to buy $7,100 in supplies. I purchase it on account. Okay, so anytime you hear the word on account, it's either going to be accounts payable or receivable, depending on what's going on. So in this example, it's obviously accounts payable because I'm going to pay them 30 days later. I've received the supplies and the bill. I haven't paid them yet. That's account payable. So our supplies went up $7,100, and our account payable, which is a liability account, also went up by $7,100. In order to increase an asset, I debit it. In order to increase a liability, I credit it. Right? This goes back to that slide I showed you earlier about the how we know when to debit or credit. So I debit supplies, credit account payable, $7,100. I post that to my general ledger account. I see my supplies went up by the $7,100. My account payable went up by the $7,100. On to the next transaction. Here we have a transaction where we provided consulting services to a customer. Okay, consulting services, as the name implies, is when we're consulting with another business. Right? I do that, I wouldn't say relatively often, but somewhat often, right? With small business owners. I consult with them about their business. They ask me questions, I provide them solutions, okay, or recommendations for their business. That's what consulting is. So here we have an example where the business provided consulting services to their customer, and the customer is paying them right away. Great. Okay, love when they pay right away. That's fantastic, especially since we only got $1,500 in the bank and we need more cash. Okay, so here we have customer paying us right away, $4,200 for providing consulting services. So our cash is going up by $4,200 and our revenue is going up by $4,200. Remember, revenue is an equity account. And to increase our revenue, we credit it. To increase cash, we debit. So we debit cash, $4,200, credit consulting revenue, $4,200, and then we post those to our general ledger accounts. So now we're doing okay with cash. We're up to
5,700.
5,700. Thank you so much. I appreciate that, Kevin. Yeah, we're up to 5,700 in cash, and our revenue is up to 4,200. Okay, so now we're doing okay. We got the business up and running. Next transaction. we got to pay rent. Okay, I made a deal with my landlord, and they said, okay, rent's $1,000 for this first month. So I got to pay them the $1,000. So this is a very simple transaction. We make this same transaction pretty much every single month. So our cash is obviously going to go down by $1,000. Our rent expense is going to go up by $1,000. Now remember, rent is an equity account. Expense is an equity account. And in this example, it's rent expense. So to increase an expense account, we debit it. And then, of course, to decrease our cash, we credit cash. And so we debit rent expense, credit cash, then we post those to our general ledger accounts. And of course, now we're down to $4,700 in cash. Next transaction. I need to pay my employees. And because my business is so new, I've decided, I'm going to pay my employees in cash. Okay, at least for this first month or so, till I get proper stuff established with payroll taxes and all that jazz. So I'm going to pay my employees $700 for the week of work that they've worked so far. Don't worry, I treat my employees better than that. Okay, so $700, paying it to my employee in cash. So cash is obviously going to go down by the 700, and I'm going to increase my expense by 700. Okay, so I debit the account called salaries expense, $700, and I'm going to credit cash, $700. Expense is an equity account, so we see the expense go up by 700, and then we see our cash go down by 700. And I've already lost track where we are with the money, so I assume we're doing all right. It's still positive, so that's good. Next transaction. Thank goodness I'm making more sales. Okay, business is doing okay for the first month. I provided some more consulting services to my customers. I also rented a small facility to a customer. So two different types of revenue going on here. Consulting revenue and also rental revenue. Right? I rented a small facility to my customer and I provided consulting services to a customer. Maybe even the same customer. So the customer said, hey, you know what? We'll pay you in 30 days or less. Okay, great. We call that an account receivable. Account receivable. They're going to pay us, customer going to pay us later. So we debit account receivable, in this case for $1,900. That's the consulting revenue plus the rental revenue. Then we're going to credit consulting revenue, $1,600, and we're going to credit rental revenue, $300. I want you to notice this transaction closely. There's actually 3 different accounts being affected here. In theory, it's really only 2. It's account receivable and revenue. We purposely break out our revenue in business, especially if we have multiple revenue lines. The reason for that is so we as managers can then go back and analyze the business's performance, right? If you have more than one revenue stream. For example, let's say, Kevin, I'm going to pick on you just for a second for this one, okay? So
Okay.
let's say, Kevin, that you have, obviously you provide the catering service, okay? So we will classify that as catering service revenue. Let's say, Kevin, just hypothetically, you decided to sublet or sublease your kitchen for a day to another small business that needed a facility for the day. Okay? That you would consider to be rental revenue, right? The reason why you want to keep those separated, Kevin, is because You want to be able to analyze all aspects of the business.
Mm-hmm.
Make sense? So
Yes.
that's why we would have a transaction like this. Thanks for playing along, Kevin. I appreciate that. All right, so we debit accounts receivable 1,900, credit consulting revenue 1,600, credit rental revenue $300. Next transaction, customers paying us the $1,900. Here they are a couple days later, like they promised, they're paying us now. Okay, so when a customer purchases on accounts receivable from you, that means they're going to pay you later. When they do pay you, you have to decrease their account receivable and increase your cash because they're paying you, right? So we have to decrease their respective account receivable because they no longer owe you the money because they're paying you the money now. So in this case, we would debit the cash 1,900 to increase the cash, and we would credit their account receivable by 1,900 and post those to respective ledger accounts. Next transaction.
So
Go ahead.
the account receivable is under an asset instead of a liability
That's
because
correct.
we credit it.
Well, so account receivable is always going to be an asset to the business.
Okay.
The reason why is because somebody owes the business money. Anytime
Account payable is a liability.
a payable is a liability, that means the
Okay.
business owes money to somebody else. Yep, you got it. So receivables is an asset to the business. Payables is a liability to the business. Great question. Excellent. All right. The next transaction we got up. We're going to make a partial payment on our account payable. Our vendors are real cool. Okay, we got a couple of different vendors. And I'm making a partial payment toward those supplies that we purchased earlier. So I made a deal with them, say, hey, I'm going to pay you $900. I know I owe you more than that, but here's a payment of $900. So to decrease your account payable with that vendor, we debit the account payable 900, and of course we're paying cash, so we need to decrease our asset by $900. And then we post that transaction to our general ledger. Feel good? All right. Next transaction. The owner's taking some cash out of the business. Okay, no problem. It's all good. Owner can take cash out when they need to. They own the business, right? So in this case, they're taking out $200. We call that owner's withdrawals when the owner takes money out of the business. So we debit the account called owner's withdrawals, in this case by $200, and we credit the cash by $200. And we post those to the respective ledger accounts. Next transaction. A customer is paying us in advance of us providing the good or the service. Anytime a customer pays you before you deliver the good or the service, we call that unearned revenue. It's unearned because we haven't provided the good or the service. We haven't earned it. Okay? Anytime it's unearned, it's a liability. And the reason why it's a liability is because the customer could always come back and say, you know what, never mind. I want my money back. Therefore, it's liability. It becomes equity or earned revenue when we provide the good or the service. So in this case, we're debiting cash by $3,000 because they're paying us in cash, $3,000 up front. Then we credit the account called unearned revenue. It's unearned because we have not yet provided the good or the service. Later on, it'll become earned revenue when we do provide the good or the service. Next transaction. I'm paying for my insurance in a year, 2 years in advance. Okay. So January 1st, or I'm sorry, December 1st, I paid for 2 years of insurance coverage for my umbrella insurance policy. Okay. Covers 2 years. It's $2,400. Pretty good deal. It's only that equates to about $100 a month. So in this case, I debit an account called prepaid insurance, 2,400, and I credit my cash by 2,400. A prepaid insurance account is an asset account because I can always cancel the policy. If I cancel the insurance policy, the insurance company needs to pay me back, the business back, that money. That's why it's an asset to the business. Okay. Next transaction. We're
Oh,
purchasing.
wait, Professor.
Yeah, please.
Uh, so for that previous question, would they pay you back the full amount, or would they only pay you like what, like a
Prorated. So,
cut rate?
yeah, great
Oh,
question, Dario. So the way that works is that let's say this insurance premium covers December 1 all the way until November 30 of 2020. What year are we in? Of 2027. Okay. So this so November 30, 2027 is when the insurance coverage ends. Let's say in January, I decided, you know what? I don't need this policy anymore. The insurance company would pay me back whatever was not used. So in other words, they would subtract out the $100 that would have covered the month of December. So they would pay me back like 2,300. So to answer your question, they prorate it, whatever's unused.
okay. Yeah.
Excellent question. And also, Dario, to fully answer that question, when we do use the insurance, it's no longer prepaid. It becomes an insurance expense. So at the end of each month, we make what we call an adjusting journal entry, which we're going to talk about, I think, next week. We would debit insurance expense and credit the prepaid insurance account. But that just kind of shows you how it's connected. Great question. The next transaction, we're purchasing supplies for cash. Very simple transaction. We debit supplies for the $120 and we credit the cash for the $120 and post those to our general ledger accounts. Next transaction, we're paying an expense in cash for $305. This happens to be for our Pepco bill, $305. Mine was higher than that, just saying. So we debit utilities expense, $305, and we credit cash, $305. Then we post those to our ledger accounts. Next transaction, we're paying our employee again. We've got to keep paying them, obviously. I mean, they worked another week. So we debit salaries expense, $700, credit cash, $700. Now you see, throughout all of these transactions we've been doing, they have been impacting our general ledger accounts, right? You know, a lot of those transactions involved cash. Some involved accounts payable, some involved receivables, supplies, et cetera, et cetera. For each account, each transaction, there were two accounts that were affected. One was debited and one was credited. And based off of that transaction, we posted that transaction to our general ledger account. When we posted to the general ledger account, it impacted all the respective individual accounts, which has an impact on the balances. It's important to understand the impact on the balances because these balances, especially for our assets, liabilities, and our equity accounts, they impact the balance sheet. Okay? For your sales, your revenue, and your expenses, those balances are reflected on your income statement. Okay? This is what builds up the financial statements. In business, we have a lot of data that we're confronted with, large Excel files that are generated from our accounting information system. The great news with artificial intelligence is you could take that file, you could dump it into your Chat GPT or into your Microsoft Copilot or your whatever's you're using, Gemini, whatever, and analyze that file, right? And be able to look at trends, understand what's going on with the data. And that data can also be analyzed using machine learning. The machine learning enables the artificial intelligence to really be able to look at those trends, to understand the impact of the data on the business. So looking at those financial statements and from all those transactions, the first thing we do is we prepare what we call a trial balance, which is a list of all those accounts that were affected in those transactions. We list them all out, and we look at the debit column and the credit column. And we need to make sure that our total debits equal our total credits. That's why we call it a trial balance. If for whatever reason these do not equal, that means that there was an error in one or more of the transactions that we entered. So we identify, looking at the trial balance, verify that the debit and credit balances are correct, do any recomputations, look at any transactions if there's something wrong, and then make any corrections if needed. Throughout those transactions were creating our income statement, our balance sheet, our statement of cash flows, and our statement of retained earnings. The income statement shows the sales and expenses that the business made over a period of time. So throughout the month of December, we recorded all of our sales, our revenue, minus all of our expenses, and at the very bottom we get to our net income. Statement of owner's equity shows the changes in ownership. What we mean by that is it shows the owner's contribution of the $30,000 at the beginning, minus the owner's withdrawal of the $200, and then plus our net income equals our ending balance retained earning. The balance sheet shows all of the balances at any point in time of all of your asset accounts, liability accounts, and equity accounts. And the statement of cash flows shows the cash coming into and out of the business for operating, investing, and financing activities. So looking at our income statement, this is our income statement generated from all those transactions that we walked through. We see our sales at the top, consulting revenue, rental revenue, and all of our expenses at the bottom, salaries, rent, utilities. Your total revenue minus total expenses equals net income. This is a very typical typical image of an income statement. The statement of owner's equity shows the changes in ownership, investments minus any withdrawals, plus net income equals ending balance retained earnings. The balance sheet shows all the balances of your asset, liability, and equity accounts. Assets, what the business owns. Liabilities, what the business owes. Equity, what the ownership owns. And of course, we look at any type of presentation things. We want to make sure the dollar sign's always there, two decimal points, etc. And as a manager, it's always important to know where your business is at all times, and ways that we can do that quickly is through what we call ratios, and one of those ratios is called the debt ratio. This tells us about the business's riskiness about taking out a loan or repaying a loan, their ability to repay future debt. And honestly, the bank will always run this type of ratio on you as an individual anytime you go to take out a loan for any reason, including a mortgage. So we take the total liabilities of the business, so everything the business owes to someone else, divided by everything the business owns, which is the total assets. We want this ratio to be well below 1. Anything near 1 is very, very risky. So the lower the better. All right, my friends, we've made it through our second lecture of this course. So what you have to do for your time that you have set aside for Thursday is I want you to go into the classroom on Thursday. I want you to come to your assignments for week 2. And we would love for you to take that Chapter 2 quiz. And that will help you to manage your time effectively throughout this semester. Is there any last minute comments, questions, or concerns that I could help to answer at this time for anyone? Okay. Next week, we're going to be meeting on campus. Okay. We'll be meeting in room 301.
Professor, it's an assignment for us to do too?
Just a Chapter 2 quiz.
Oh, just the Chapter 2 quiz, that's all?
That's it. That's all you owe me by Sunday night.
Oh yeah, I know, but is it something that we can practice what we just went over? Did you put another some more
yes.
exercises? Okay.
Yes, absolutely. Yeah, please
Okay.
feel free to use those exercises. They're definitely there to help you.
No problem. Okay. Thank you.
Yep. There's Excel exercises and the Firebirds Cookie Company exercises as well.
No problem.
Yep. Awesome. Any other comments, questions, concerns? Okay. I look forward to seeing you all on campus next week on Tuesday in room 301. Okay?
Thank you, Professor.
Thank you all so much. Have an awesome
you.
rest of your night and a great
Thank
week
you,
ahead.
Professor.
Thank you, teacher. See you
Thank
Thursday.
you.
Thank you. My pleasure. Take care, y'all.
Have a
Have
good
a good
one.
night. Bye-bye.